Well, today again, the Monetary Policy Committee kept the repo rate unchanged at 6.5% for the 8th consecutive time. To discuss the key highlights of the policy, today we have with us Mr. Deepak Agarwal, CIO Debt and Head of Products. Welcome, sir.
Hi, Sukanya.
Was today's policy in line with market expectations?
Yes, broadly the policy was in line with market expectation. Some market participants for last few policies have been advocating a change in stance given that we have 2% positive real rates. And this week we had the rate cuts by ECB and Bank of Canada. So barring the small section of the market, broadly the policy was in line with expectation. GDP forecast has been revised higher from 7% to 7.2%, while retaining the inflation target for FY25 at 4.5%.
Do you feel in the coming months RBI will change its policy stance from withdrawal of accommodation to neutral? And do you expect a rate cut in August policy?
RBI in April suggested that inflation is the elephant in the room. Inflation and the elephant has walking towards the forest, and RBI wants him to stay in forest for a longer period of time. So basically, RBI wants more confidence that inflation is heading in the band of is trending lower towards 4% and likely to stay in the band of 4 to 4.5% for a long period of time. And so by let's say by August policy, RBI will have more clarity on the monsoon front. Currently, the Fed fund futures are pricing close to 40 to 50 basis point rate cut in calendar year 2024. So by August, RBI will have more clarity as to the total quantum of rate cuts in Fed and the timing of rate cuts in US as well. Third, post the elections, there are expectations that the fiscal deficit for FY25 might be increased and the expenditure mix may also be revised. So, basis assumption of a normal monsoon, Fed rate cuts during the year, and government sticking to let's say 5% inflation, 5% fiscal deficit target, we believe that there is a high probability that RBI may change the stance in the August policy. With respect to rate cuts, we expect RBI to cut rates only in the second half, and in this cycle, we don't expect more than 50 basis point rate cut over the course of let's say next 1 year.
Now, speaking of Fed, do you expect in the upcoming June meet next week, do you expect the Fed to cut rate? And if not, do you at least expect 1 or 2 cuts in 2024?
So, let's say currently if you look at Fed fund future or currently the Fed dot plots are currently giving a guidance of 75 bips rate cut this year and 75 basis point rate cut next year. Now, data out of US has been mixed. The recent data has been weak and the past numbers are also revised lower. Today we have an important data in US. The NFP numbers for the month of May will be released. If the numbers are lower, then probably the expectation of cumulative rate cuts during this year will increase above 50 basis point in US. So next week we have the Fed policy. We believe that Fed, depending upon today's data, will continue to keep rate cut expectation for this year anywhere between 50 to 75 basis point and rate cut expectations for next year, which is calendar year 2025, at 75 basis point. With respect to rate cuts in US, we believe that probably Fed will start cutting rates only from September 2024 onwards.
Sir, like you mentioned, real GDP growth projection was raised to 7.2% from 7%. What do you think? RBI is drawing comforts from what all factors?
See, RBI, one, for FY24, we had a strong growth. We had a growth of 8.2%. So, yes, from FY24 8.2%, they have revised the growth for FY25 at 7.2%. But yes, in April they projected 7%, but they have revised it higher to 7.2%. So RBI seems to be drawing comfort from multiple factors. One, let's say the 8 core industries growth data has been strong in April. If you look at the PMI, both manufacturing and services PMI has been strong. Third, the fact that your export growth for goods was positive close to 1.5% in April, and the services export growth was also strong at 17% in the month of April. Plus, expectations of normal monsoon this year is going to support your rural consumption, and service sector is going to continue to support your urban consumption as well. And the investment activity is likely to be supported by healthy balance sheets of bank, corporates, and the government focus on capex. So all these factors put together is giving confidence to RBI that growth for FY25 is likely to be closer to 7.2%.
Now, what are your expectations from the upcoming full budget for debt markets?
So again, let's say if you look at FY24 fiscal deficit, in February the FY24 fiscal deficit, again it's a past data, but it was projected at 5.8%. But due to increase in GDP, the last year fiscal deficit number is also lower at 5.6%. Now, based on revision for FY24 fiscal deficit, FY25 fiscal deficit, which is projected at 5.1%, also comes in lower. In addition to that, RBI gave a dividend which was way higher than what is projected in the budget. So that reduction should result in reduction in fiscal deficit, and fiscal deficit number could be closer to, let's say, 4.7% on account of RBI dividend and on account of revision in the base numbers. Now, post-election, there is an expectation that probably government might increase its expenditure, and the expenditure mix might also change. But we believe that our expectation is that the fiscal deficit for FY25 is likely to be closer to 5%. And even with the revision in the fiscal deficit for, let's say, FY25, we don't expect any supply of bonds, any incremental supply of bonds than what was projected in the February 2024 budget.
Lastly, sir, how are the debt markets poised? Do you think it is time to add duration to the portfolio? And which categories of fund will you recommend for investors in the current scenario?
So we have been advising investors to increase duration of the portfolio for last 6 to 9 months. And we believe that interest rates have peaked both globally and domestically. And in fact, we saw 2 advanced economy central bankers cutting rates, which is Bank of Canada and ECB. So let me break up that part with respect to our interest rate view, both short-term and long-term. So short-term rates, the core liquidity in the banking system has increased to 3.5 lakh crore. With the government coming into power, and once they resume their spending, we expect the liquidity in the system to increase, which should result in short-term rates which have been slightly elevated to trend lower. Plus, our view is that RBI will cut rates by 50 basis points over next 1 year, which should also lead to which also supports short-term yields trending lower. With respect to long-term rates, we believe our macro story is very positive. So let's say our central banker is ensuring that inflation continues to trend lower at 4%. Second is that the fiscal situation is very good. Government is likely to peg FY25 fiscal deficit at 5% and continue to guide for 4.5% fiscal deficit for FY26. So the demand-supply situation, both domestically, the demand-supply situation is very favorable. In addition, we have index flows and rate cut expectations over the course of next 1 year, both globally and domestically. So all these factors favor that the long-term rates can continue to trend lower. And we believe that the 10-year GSEC, which is currently trading at around 7%, can be in the band of 6.5 to 6.75 1 year down the line.
Well, that's all for today, viewers. Thank you, sir, for joining in and for all the insights. Hope it helps all the investors out there.
Yeah, thank you, Sukanya.
We will be back soon with another interesting discussion. Keep following Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.